Hello, Baker MBA finance students. We are now officially halfway done with the course, so just keep plugging along. Good job with the forum discussion this week again. Appreciated everyone giving great examples relative to different types of investment decisions. And as we know, sometimes, investment decisions work well, other times they don't. So in business, sometimes we take risks, and we have to assess those risks. And we kind of continue that with this week with the idea of an opportunity cost, coming up with an appropriate rate of return for your opportunity cost. So a little bit lighter this week in the chapters reading. You have chapters 12 and 13. Also have your homework problems based on the material from the previous week. And with the forum discussion this week, based on the company that you've selected, I want you to go out and calculate the required return on equity, we call stock, or the CAPM model. So I've provided an example out there for you in the forum discussion relative to Kellogg's. And you'll notice with Kellogg's right now, with a beta of 0.62, the required rate of return is a lot lower than the market average. So for this, I want you to use a market return expected of 10%, a risk-free rate of 3%, and follow the example. And then with the other part of the forum discussion, based on what you're going to do with your equivalent annual cost paper, provide in the discussion, how did you come up with the rate that you viewed as an opportunity cost? That's subjective. If you just want to not think about it too much, you could just say 6 to 8%, or you can go down to 4%. But in reality, you should base it on an opportunity cost that you feel that you could earn somewhere. So it's going to vary by each individual's perspective about the amount of risk they're willing to take on. You might say, hey, I could have put this money in the stock market and earned 10% during this time period. Or I'm a little bit more conservative investor, I would put it in something like bonds that may have only earned 5%, or maybe, I would keep it in something like a money market fund that might only earn 2%. So just give a reason for that in the initial post, and then follow up with a question, comment, response to at least 2 other students by midnight, and you'll be good to go. Again, I encourage you to kind of jump in early, get that done early. If you can jump in Monday, Tuesday, it makes it so much easier that you're not having to deal with it at the very last thing during the weekend when other assignments are done. So with this week, with chapter 12 first, we look at the CAPM model. The capital asset pricing model was a model that William Sharpe won a Nobel Prize in economics. And he looked at some measure that says, hey, that I can take into consideration a firm's riskiness based on the beta. So as we kind of think about the idea of beta again, if you have a beta equal to 1, it says that the stock market goes up 10%, then your stock would go up 10% on average based on historical returns. If you had a beta equal to 2, it's a greater risk, because if the market goes up 10%, your stock goes up 20%, but if the market goes down 10%, your stock goes down 20% based on historical returns. So, and he did this by saying, hey, if I take the risk-free rate plus beta times that market risk premium, the difference between the market return and the risk-free rate, that gives an appropriate rate of return for an opportunity cost. And this leads to our following chapter. When you look at weighted average cost of capital, this looks at, say, hey, now that I got this required rate of return on equity, I have this required rate of return on debt, which includes the after-tax cost of debt, because we get a benefit from using debt, because for corporations, we get to deduct that interest expense. And then if you have any preferred stock, so if a company was half weighted with debt, half weighted with equity, if the required rate of return on equity was 20%, well, I would take 0.5 times 20% plus, and let's say that for the after-tax cost of debt was 8%, then I would do 0.5 times 8, so then I would have 10 plus the 4, and we'd have a required rate of return of 14%. So this is where we're truly getting to something that now that I have a good opportunity cost to discount my cash flows back on. In the previous examples of net present value, we just made an assumption about the interest rate. Say it was just given 10%. But now we have something to help management decide that, yes, this is a project we should take on because it meets our required rate of return and it adds value to our shareholders. And if it adds value to the shareholders, there's a positive net present value, and that, in theory, should increase the price. And that's what stockholders are looking for. They're wanting us to make decisions. They're going to increase the value of the firm. So, well, that was it for this week. I'm going to keep it brief, but do email me if you have any questions. Continue to work on the homework, get that submitted, and just stay on top of things. A week from now, we will be looking at another exam. This coming week, I will be in Portland part of the week, but I will be checking email on a daily basis in the forum discussions, and I'm going to take your all's advice. I think it might have been Jester, someone said to check out Voodoo Donuts, but I will get there and try one out. So I think it was the maple bacon one, perhaps. So otherwise, go Royals. Have a great week, and we'll talk to you soon. Bye.